Hello, and welcome to our second Primetime virtual event. My name is Bob Pickel, and I'm the chair of Prime Finance. And I'm delighted that all of you from across the world and from many different time zones are able to join us today. Before we turn to our topic for today, let me go over a few housekeeping items. Now, this session is being recorded, and you've sort of seen a window indicating your consent. But in any event, attendees who continue to participate will be taken to have consented to such recording. Attendees are muted and have their video turned off. If you have a question or comment, whether for the panel or of a technical nature, please use the Q&A function to get in touch. It can be helpful to include your name and affiliation. Questions for the speakers are welcome throughout. We may turn to them at the end, but if something is relevant as we go through our discussion, we'll certainly answer it at the appropriate time. We'll use the chat box to send messages to all attendees during the course of the session, so I would encourage you to open up the chat box as well. I'd like to thank DWA Financial Technologies for their sponsorship of the first series of Prime Time, and I also would note that I'm a board member of DWA Financial Technologies. Finally, I'd like to thank LexisNexis and MLEX for their support of Prime Time and their assistance with the promotion of our events. Today's topic is, what does the pandemic mean for financial regulation? The pandemic has caused a more severe recession than the 2008 global financial crisis and provoked an incredible governmental response that is similar in many respects to what was done in the global financial crisis, but different in some ways. What does that say about the regulatory changes made following the 2008 crisis? What worked, what didn't, and what changes are we likely to see to financial regulation as a result of the pandemic? To discuss this, we have two people who are extremely well placed to consider the effectiveness of the reforms in the face of the pandemic. They were at the center of formulating and implementing the financial reforms on both sides of the Atlantic. Tim Massad is currently Senior Fellow at the Kennedy School at Harvard. He's an adjunct professor of law at Georgetown University Law Center. Most relevant to our discussion today, he was chairman of the Commodity Futures Trading Commission in the US, and he was also former assistant secretary for financial stability at the Department of Treasury as implementation of financial reforms and aid programs were being implemented. He's a former partner at Cravath, Swaine & Moore, and that's where I first met him. He's also a prime finance expert. Dr. Kay Swinburne is vice chair of financial services at KPMG UK and previously served in the European Parliament as a member and as vice chair of the European Parliament's influential Economics and Monetary Affairs Committee, where she was extremely involved in developing the various European responses to the global financial crisis. Prior to her career as an MEP, she worked in investment banking. Now, we're going to turn to Kay and Tim to get their thoughts on the effectiveness of the financial reforms following the financial crisis. But first, we want to get your views. So you'll see a poll question that will come up very shortly on your screen, and I would encourage you to consider it. Now, as you're thinking about that question, I thought I would briefly mention the range of financial regulations put in place, very briefly, after the global financial crisis. In the derivative space, the focus was on greater use of clearing, alternative means of trading, reporting, increased use of margin, and higher capital requirements. In the banking area more generally, there were various changes to the capital rules, restrictions on proprietary trading, such as the US Volcker rule, and changes to the rules on bank recovery and resolution, including creation of living wills. In the US in particular, there was a focus on consumer finance with the establishment of the Consumer Financial Protection Bureau, although that is somewhat called into question after a Supreme Court ruling last week. Okay, well, that's a quick overview of what occurred. We're going to close the polls, but we're going to hold off on getting the results up on the screen until we've heard from our two experts. So, Kay, what are your thoughts on the effectiveness of the financial reforms?
Thanks, Bob. And it's been like a trip down memory lane coming together to actually get the thoughts on how the global financial crisis preparations and all the subsequent series of Eurozone crises precipitated that full-blown regulatory response, many of which were global in nature, others were specific to the EU and other regions around the world. And the pre-existing global banking structures, such as the global network of central banks, the Bank of International Settlements, and that Basel Committee, whom we now all know so well, meant that new prudential standards for banks were able to be agreed relatively quickly, where the result has been the raising of capital requirements for the global banking sector. And of course, there have been several subsequent adjustments during the last decade, all of which have improved the capital buffers to enable the interconnected global banking system supposedly to be able to absorb shocks. And I'd suggest they've done fairly well over the last few weeks and months. The other significant global initiative on financial regulation came about as a result of the G20 initiative in Pittsburgh back in 2009, which set ambitious plans for the OTC derivatives and the need to move, of course, the OTC trade where possible to trading venues and to utilize central clearing and new central repositories. That primarily so that regulators could oversee the exposures of the global participants in the derivative world, and for counterparties, I guess, to have confidence in each other and the system as a whole. And I suggest again that that seems to have worked well as a result of this financial crisis and seems to have held up. And all these two main pieces of regulation globally were followed by a myriad of global standards from bodies like the CPMI IOSCO on financial market infrastructures. There were local regulatory changes to strengthen the financial regulatory frameworks where weaknesses during the financial crisis had been observed. And I'm sure Tim will no doubt elaborate later on that delightful single piece of legislation, the Dodd-Frank Act. Whereas in Europe, where I was playing a role, we took a much more piecemeal approach, putting in dozens of financial services legislation to try and prevent as severe an impact the next time the markets were tested. So more than a decade on from that last financial crisis, the legislative framework, I would suggest, has just undergone a major real-life stress test. And it seems to me that the UK and European capital markets, along with the other global financial centres, have continued to function perfectly adequately during the COVID-19 pandemic. And for me, have demonstrated resilience despite increased volatility and certainly despite increased uncertainty. And it seems that at the beginning of the pandemic declaration, back in early March, we saw record volumes and record volatility, and most importantly, I think record margins being called. Sometimes those margins being called 4 times a day from different market participants. And this volume of trading seems to have been maintained about 3 times the normal levels. And seemingly, despite all of that, the financial market infrastructure is holding up. So I think financial market activity is an indication that European capital markets are holding up. And so in that first month of April, post that pandemic being called, we saw 50 billion of investment grade corporate bonds being issued in the first week of April. That suggests to me that there was liquidity, there was price formation, and despite an early blip, settlements were then timely and clearing operations were working well, even with the substantially increased volumes. So as someone who's been involved in that financial services regulatory reform over the last decade, where we took a lot of flack for the amount of regulation that was put in place and indeed the cost of regulation for the financial market participants, I viewed the last 3 months of trading and post-trade activity with a mixture, I guess, of relief and occasionally pride, as the market infrastructure seems to have been stress tested for real, and I'd say it's past muster. And I'd say that the financial services regulatory framework that we put in place after the last financial crisis, which really was extensive in Europe. So we had EMIR, we had MiFID, we had CSDR, SFTR, a whole alphabet soup. It all tried to formalize the infrastructure oversight on the rule books to ensure a safer system overall, which was more resilient to global shocks. And the results so far suggest that it was worthwhile, that most of them have worked, but they've only worked, I believe, because they were carried out in conjunction with that overhaul of bank capitalization globally and those new recovery resolution schemes that you referred to, Bob, in your opening remarks. They've worked. They've certainly actually had the confidence-inspiring sort of intent that they had when those central bankers put them in place. And I think the new highly coordinated dialogue amongst international regulators and among central banks and market supervisors, and indeed all the treasury departments around the world, are now in frequent dialogue. When this pandemic was called, they all spoke to each other and were able to maybe not coordinate, but certainly collaborate over the interventions that they made. So it's been an important test, I think, not just of the financial regulatory system, but also a test of supervision, a test of the banking systems, of monetary policy coordination and fiscal responses, as well as the global prudential and market coordination. So I think the last few weeks have shown resilience. I'm actually very confident that they have absorbed a wide number of the shocks, including, as I refer to, the volatility. We've also had credit risk tested, and the operational continuity plans with off-site working have also seemingly stood up. So I think it's taken off some of the pressure from the financial market infrastructure, but it's still a testing time. And I think regulators have been trying to assist the functioning of the capital markets in particular through regulatory easements. And in the UK, we've seen moves to lower hurdles, like reducing the burden on things like prospectus requirements, and they relax things like the preemption group guidelines temporarily so that listed companies can raise capital more easily. All of these are important measures that oil the wheels of the financial markets and assist companies and governments raising emergency capital to cover those unexpected costs. So it would seem to me that the financial reforms of the last decade, I would suggest probably quite controversially, have stood up to the COVID test, and the global system has demonstrated, for me, resilience. I'm going to stop there, though.
Well, let me first of all thank Bob for inviting me. It's a pleasure to be here, and greetings to everyone around the world, and greetings in particular to Kay. It's great to see you again. We spent a lot of time together on a variety of these issues, and I agree with a lot of what Kay has said, but I also want to note maybe a few other issues. I would first of all put things in three buckets. There are those reforms coming out of the global financial crisis that have been shown to have worked by this pandemic. That's bucket number one. Bucket number two is the reforms that haven't been tested, at least not yet, as a result of the pandemic and the recession. And bucket three is reforms that haven't worked, or at least areas where we didn't fix it. So what worked? Well, that's where I agree with Kay. Clearly, the higher capital levels of banks, as well as better liquidity for banks. And I would couple that with, in the US, the greater role of the Federal Reserve in overseeing bank health through stress testing and so forth. So our banking system has been more resilient. It's been able to continue to provide credit, and we haven't seen a retrenchment, at least not yet. I would also agree that the derivatives reforms have worked. That market has continued. The volatility has not caused any disruptions. Bucket two, what hasn't been tested? Well, that's where I'd have to say all of the reforms that deal with what do we do about a large, systemically important failing institution. Resolution planning, orderly liquidation authority in the US, TLAC, those things simply haven't been tested. We haven't had a large failure. Let's hope we don't, but we'll have to see. Bucket three, what hasn't worked? Well, there I think you have to say that at least in this country, the money market reforms, money market fund reforms, the imposition of fees and gates that were supposed to stop a run may have actually accelerated the beginnings of a run in March. In addition, we had some very serious dislocations in the Treasury market. Now, that is not an area that was really on the radar screen coming out of 2008, but those dislocations were very troubling given the importance of that market. We had intense selling pressures, investors wanting cash, very wide spreads, yields rose. Typically, when you're in a period of very bad news, prices rise and yields fall. We didn't see that. And so the problems were due to lots of factors, the growth of the market for one, the role of hedge funds, I think, and the leverage they had in that market. You might say that the reforms that we implemented prevented a credit crisis, but may have contributed a little bit to a liquidity crisis in that banks were unwilling to expand their balance sheets because of capital and HQLA and SLR requirements. So what you had with these things was corporations couldn't roll over commercial paper easily. You had the seeds of another financial crisis in March, and it's really only because of extraordinary interventions by the Federal Reserve that we, I think, may have avoided some more serious problems. The Federal Reserve purchased $1 trillion in Treasury securities in 3 weeks. And then they provided massive liquidity to financial markets and credit to the economy. They re-implemented swap lines with foreign central banks. Those reached heights that were very near what we had in 2008. They relaunched a variety of facilities that we did in 2008, commercial paper funding facility, primary dealer credit facility, a money market liquidity fund. And in addition, they went further by implementing several new facilities to provide credit to the broader economy through the Main Street Lending Facility, the Primary Market Corporate Credit Facility, Secondary Market Corporate Credit Facility, and so forth. So, you know, really we had very massive intervention by the Federal Reserve. Now, you could step back from this and say, well, gee, some of us had worried that as a result of Dodd-Frank, it put some constraints on emergency powers. It did limit the Federal Reserve's power under what's called Section 13.3, which had been used in 2008 for the interventions with Bear Stearns and AIG. We had limited in Dodd-Frank those powers so the Federal Reserve couldn't assist a single company, but it didn't need to. It only needed to launch these broad-based facilities, which it was able to do. And frankly, I think what we saw on the part of Congress was Congress acted to remove some limitations that had been imposed before, but more importantly, Congress didn't know what else to do. So it gave authority to the Treasury to backstop additional Fed facilities. The CARES Act gave Treasury $454 billion, which is more than what we expended in the TARP program to backstop Federal Reserve facilities. You might ask, well, is more credit what we needed? We went into this pandemic-driven recession with a very high leverage, but the fact is, that's what we know worked last time, so that's what the Fed did. Congress didn't know what else to do, and I think people were not willing to say, oh, let's just let the bankruptcy system deal with failures and we'll provide unemployment insurance. That seemed far too harsh given the nature of this. So, you know, we had massive interventions by the Fed, and I think you've got to say, particularly with money market funds, well, gee, this is the second potential run on money market funds in 10 years. The financial stability solution of having the Fed intervene is not great. So I think that is an area we need to look at. I think the other thing to remember, of course, is we're only in the early stages, potentially, of this recession. Let's hope it doesn't get dramatically worse, but it could. We don't know how long the pandemic will go on. We don't know how many bankruptcies we'll see. We don't know what pressure that will put on bank balance sheets. And there's a lot of other aspects of this that, you know, could lead to problems. You got a lot of people working from home, which creates greater security risks at firms. You couple that with the general cybersecurity risk that we know we have, those are concerning. So I don't mean to project doom and gloom, but I don't think we should be declaring victory just yet. this is still, I think, a perilous situation, and we need to be very watchful of what happens next, and particularly with all the complexities of international pressures. I agree with Kay that one of the things that we did coming out of the global financial crisis was the cooperation among financial regulators, and I think that was a foundation that regulators could work with this time around. But I worry that the rise of nationalistic pressures, of protectionist pressures, and so forth can threaten that. And so I just think we have to be very mindful as we go forward here. Let me stop there and turn it back to Bob.
That's great. Thank you, Tim, and thank you, Kay, for those remarks. I should mention that you recall, we have a poll, and so I'm going to ask the poll results to be put up so we can compare the thoughts of the audience before they heard from the experts. So we, certainly resoundingly in the somewhat effective or very effective 68% total, which I think meshes with what we heard from Kay and Tim. Maybe they're a little bit more in that very effective range, but fair enough. And very, very few said they were ineffective, so only 12%, and a few neutrals and no opinion. So I think largely consistent, and I think that's certainly my observation as well, that the markets did well. But I think as Tim noted, it took extraordinary efforts here in the US by the Federal Reserve in particular. And I know that was not just sending a strong message to the US markets, but to the global markets as well. And so that was an important thing, and maybe something you can't always rely on, but it's good that it's good that it was there this time around. I should mention, Tim talked and Kay talked a bit about the effects on markets. So just so you're aware, we have our next Prime event, Prime Time virtual event. Next Tuesday, we have Gay Huey Evans and Blythe Masters, who will talk about some of these market effects, some of which Tim touched upon in terms of disruptions in the treasury markets and money markets and areas like that. The other thing is the question of insolvency is going to be a big issue. Bankruptcies are occurring. People are looking at the insolvency laws. We have a new law coming into effect in the UK, and we're going to have a session that you'll hear about. There'll be an announcement coming out shortly about a new session on the Insolvency Act in the UK. That'll be later in July. And then in our second series, we anticipate having a discussion among insolvency experts more broadly about insolvency effects of the pandemic. So stay tuned for more information regarding that. Now we've done a little look back here. Let's do a little looking forward. Tim alluded to some of those things that are yet to be considered. Are there areas that policymakers should focus on to adapt financial regulation in light of the experience with the pandemic? And I guess I'm asking Kay and Tim to gaze into their crystal balls. And while the focus is on policy, it's inevitable that we'll talk a little bit about the politics in the US, the UK, and Europe. So feel free to touch upon Brexit, Kay, and Tim, feel free to touch upon the upcoming US elections. Kay, your thoughts?
So I think there are quite a lot of things, and I agree. I mean, I'm one of Wall's serious optimists, and so my glass is always fairly full. So I think looking at the crisis that we've had so far, and the fact that the framework has stood up is obviously sort of, for me, a very, very significant positive. But I mean, Tim is right that there is a huge bleak moment coming ahead of us. I mean, we have had unprecedented government intervention. And I've just got to look at the UK. The UK has effectively been paying a third of the workforce since March. So, how long do governments go on paying workers to sit at home and be furloughed, the phrase that we're using here in the UK? And the same measures are being taken across most European countries, and very aggressively. So the government interventions are huge. They're intervening with 100% guaranteed loans for all small and medium-sized enterprises. I mean, many of those will be so indebted, over-indebted, that they will not be able to repay those loans. We're expecting a very high number of those loans as a percentage of a normal loan portfolio to actually be defaulting. Therefore, the governments are on the hook for a large amount of this, but so too are the banks. And I think Tim did sort of note that the caution that needs to be put there, that lending that was made pre-COVID-19 is likely not all to be sustainable. And therefore, what do you do? So my policy ask right now is something that I spent 10 years looking at in the European Parliament and never found the answer. And I think it needs a much more concerted effort now, which is how do you move particularly European companies from their relationship with debt and convert it into one of more of an equity standpoint. So very few companies go the equity route. Most go the bank loan route. And it's an 80-20 rule in Europe. We have 80% of companies financing typically will come from the banking sector. So that over-reliance on the banks is huge. Whereas in the US, typically it's 80-20 the other way around. The capital markets work much more efficiently, and equity is a much more useful instrument in the States to Europe. And I think we need to find that there is not going to be a single answer with, I've looked for it for 10 years and failed to find it, but there needs to be some policy responses that make it easier for companies to go an equity route. We need tax breaks to make sure that equity gets treated at least with parity with debt from a tax perspective in Europe, rather than there being inbuilt tax advantages for debt. So I think, there are some big things that policymakers are going to have to look at in terms of financing of SMEs, and particularly high growth SMEs going forwards, and trying to get that cultural shift. Europe is also going to have a cultural shift from a culture of savers. Countries like Germany have got the highest rate of savings per GDP, but they don't invest typically in the capital markets. There's no risk appetite. And in the long-standing low interest rate environment, policymakers are going to have to look at how you encourage that cultural shift. And we haven't seen that in the last decade since the financial crisis. I just believe that they need to do more in order to try and encourage this. And so policymakers should be focusing on those here in Europe. I think slightly different in the States, so there will be differences in this. And I'd like to see an increase, not a decrease, in that global regulatory coordination. I think we've just seen the dialogue between the central bankers, the dialogue between the different institutions was great at this point in time, but they still didn't coordinate. They did inform one another before they did stuff, but moments before. It wasn't a coordinated effort. So, the UK Bank of England could have probably saved a lot of its powder and kept it drier for a bit longer had it known that the Fed was going to open up the swap lines before it committed such a large amount to its purchasing schemes. So I think if they coordinated a little more, we could have seen a lot more happen, and a lot more impact in terms of getting that confidence into the marketplace. So whether there's appetite for it, whether we've reached the peak of global coordination and collaboration amongst the regulators and supervisors, I don't know. But I'd like to hope that's not the case. I'd like to think we are actually going to increase that cooperation, at least at the regulatory supervisory level. But then you mentioned Brexit. There's one big spanner in the works, even to get Europe working as it used to as one with, as a continent, given the fact that the EU makes up 27 of the countries in that continent. There's a number of them outside of the EU formal structures. And the UK and Switzerland last week announced a new regulatory cooperation in financial services, which for me would be the perfect template for all global financial centers to agree that they would have that enhanced level of coordination cooperation between different global financial centers. So the UK and Switzerland step in the right direction. I think if we could actually step that up across the entirety of the global financial centers network, I would be a very happy person. So I think, there's a lot to go, but Brexit complicates things even between the UK and the EU. Equivalence decisions, something that Tim and I spent many, many evenings, late into the evening, discussing how we were going to break the lock that happened between the EU and the US on CCP equivalence. The UK is going to be undergoing that over the next few weeks and months. And, the idea that this is a political decision ultimately by the EU rather than a technical assessment really causes me sleepless nights. And so that for me is an area that, you know, as much as I want the global enhanced cooperation, we may have a few bumps along the way in the short term to get over first.
Well, again, I agree with a lot of what Kay has said. Let me note two things, two issues in particular. First, the need for greater global cooperation is key. I couldn't agree more. I am worried, very worried about that, again, with the rise of nationalism, with the rise of protectionism. And, you know, the pandemic has kind of increased this focus on, well, you know, what's in our nation's interest? What do we need to build here? What do we need to have here? Will that spill over into making it more difficult to have cooperation in financial regulation? I don't know. Second, Kay noted the importance of how do we shift companies to finance more with equity and less with debt. We had very high leverage going into this pandemic. I think you may see calls in the US, an increasing number of calls where people question the tax deductibility of interest payments. There's going to be a lot of resistance to changing that. But again, depending on the outcome of the election, and a lot of these things depend on the outcome of the election, we potentially could see something there. Let me note though, five or six other areas in particular where I'm kind of keeping my eyes on them. First, in terms of the banking sector, as we've said, I think the experience of the pandemic thus far, at least, supports what we did in terms of higher capital requirements. And, you know, when you look at what the Trump administration has done, they've tweaked Dodd-Frank, but you know, they've had 70 votes to repeal Obamacare, or the Affordable Care Act. They've never tried to take a vote to repeal Dodd-Frank. So, you know, I think the basic structure is sound. You know, we're not going to see significant changes, I don't think, on the bank or derivatives front. Second, I noted money market funds, the importance of looking at that again. I hope we do that. Third, the Treasury market. There is some talk now of central clearing for the Treasury market. Treasury market has grown enormously, and you know we're relying on largely a bank intermediation model. We've seen a lot of liquidity come from other funds, from hedge funds and proprietary trading firms, but that liquidity often quickly disappears when there's a crisis, and that ties into concerns about high frequency trading and so forth that I hope get more attention. But in any event, I think we may see people focus on the Treasury market. Another area that may not be on the minds of many in the audience, but I think is going to get more attention, is payment systems. And there's really a confluence of influences affecting that. You've got the pandemic influence, which is going to be a push toward electronic payments more and less use of cash, both because people worry that cash spreads disease and because of more online transactions. You've got the influence of fintech with the development of private digital currencies like Facebook's Libra proposal. You've got many nations looking at central bank digital currencies. China recently started testing its own. A lot of European countries, including the UK and France, are seriously looking at this. And a lot of that's driven by geopolitical concerns about desires, at least in China, potentially elsewhere, to lessen the role of the dollar in the world. And I've recently written a paper on Libra and CBDCs and so forth, and some of the things that might happen in this area. So, you know, and it also ties into the fact in the pandemic, when we tried to get stimulus money out to people, you know, 35 million people still had to get checks, and it took an extra month. So we may see something there. We don't have in the US federal regulation of payment systems. The controller of the currency has recently come out saying we need a new payment system license. And this also plays into what's the role of the Fed? Because when you talk about central bank digital currencies, people start talking about, well, why shouldn't the Fed payment system be available to more Americans? And that brings me to my other issue, which is a general issue about what's the role of the Fed. We may see a lot more discussion about what is the role of the Fed given its extraordinary interventions. It's going to have a very large balance sheet for many years to come. It's going to own a lot of corporate loans. It will have losses. There will be exit issues. There potentially could be some fraud in some of those loans. Who knows? There will be talk about who won and who lost, who got a loan, who didn't. And the reason I'm pointing all this out is I think we could just have a lot of talk about, well, what role do we want the Fed to play? Should it be as independent as it is? Does it become more politicized as a result? Do we move towards central banking for all with some kind of central bank digital currency? So some very, very interesting issues. And of course, all of these issues, the range of possibilities varies depending on the outcome of the election, both who controls the White House and who controls the Senate. And it will depend on the path of this recession and how bad it gets and how much strain it puts on the financial system. So those are a few thoughts.
Yes, thanks, Tim. Actually, just a couple of questions, one for Kay, one for Tim. Kay, any thoughts in terms of these 5 areas that Tim outlined? And Tim, any further thoughts on equivalence, which, as Kay noted, was something that the two of you worked on very closely. Are we facing the breakdown of equivalence? So one for Kay, one for Tim.
We found there was a significant problem, certainly in the UK, with regards to the gilts market. And we were having a serious run on the pound back at the very beginning of the pandemic announcement. And so there were some very significant measures that were put in place by the governor of the Bank of England, who'd only been in post, I think, like 2 weeks before. So he was new to the job and had to make what was effectively unprecedented interventions in the marketplace. And they were very aggressive interventions that he made. But there was still an enormous amount of slippage until the Fed made their swap lines available. And so, for me, it just demonstrates the interconnectedness of the markets and the fact that the power of that global coordination, and it would have been so much more powerful had it been done together in the first place and sort of communicated in a much more, I guess, the ECB, the Bank of England and the Fed, if they had in some way colluded with each other, I think you would have had a better outcome for the taxpayers of all 3 regions if they'd done it in concert. So the reality for me is that treasuries were a problem in the States, gilt markets were a massive problem for the UK, for the Bank of England, but their responses, whether it's the ECB, the Bank of England, or the Fed, have been the same. So I guess they learned the same lessons, and therefore it's the same responses, the same toolbox that they've used. Question is, does that store up bigger problems going forwards, given the fact that they've all got the same exposure now, the same very large balance sheets, the same type of investments on their balance sheets? I just wonder whether you're storing up problems for the next generation almost, because they're so large that to unwind these is going to take a very long time. We have less reliance in Europe on the money market funds. So I think there's less of an issue, but there still is. And I haven't seen the data yet on how they're holding up. There haven't been any complaints. I'm assuming there was no catastrophes in this. But interestingly, I think the Wirecard failure in Europe is causing major problems with the payment system. And the interconnectedness of the global payment system, not allowing one regulator to see through what happens in one jurisdiction versus another, is causing a major issue. And so a company, a very relatively small newcomer company like Wirecard, which was a unicorn that had a very large market valuation, but ultimately, has been found that you cannot track the cash reserves that it supposedly had in bank accounts in Asia. And the fact you couldn't check that, a German regulator could not verify whether or not that money existed or not, is actually a demonstration that the system needs to be looked through again. And I think the payment system has been dealt with on a regional basis rather than a global basis to date. And I think that's the one that I would agree is ripe for a lot of work by the global regulators. Who does it would be the question. Does this fall to the central banks? But not all central banks have got the oversight of payment systems. Some of them are the market regulators. So there's no consistency across jurisdictions for whose responsibility this is. And I think it's going to be a difficult one. But given you've got the traditional payments players, you've got the fintechs playing in this space, you've got lots of intermediaries now playing in this space and actually creating that patchwork. I think this is the area that I would be looking at on a global basis for how do you coordinate that regulatory landscape going forwards. And if the G20 were going to do anything in the financial services space of any use, I think this is where I would suggest that they put their firepower right now. So I'd agree with him that payments is something we really have to, even with existing payments, it's where we have to put some attention. That's before we have the digital payment system of, all those delightful new currencies that potentially might be out there, in various token forms, or indeed, sort of whether they have access to the Fed or not, they are going to be players in the system going forwards and may well disintermediate everything that the regulators put in place if we don't bring them into the fold early.
Right. Tim, any thoughts?
Yeah, on the equivalence question. Well, obviously, as Kay noted earlier, Brexit put a lot of strain on this, both from the standpoint of now, of course, the UK has to go through equivalence, but also the EU's response in terms of its new standards that affected the US European deal. Stepping back from it, we obviously have made clearinghouses much more important in the global financial system. They are potential single points of failure, and we have to avoid failures given their importance. So you say, what is the system that we need to have? And, to me, we're maybe several years still away from it, but we need a Basel type equivalent for CCPs. Yes, they're located on someone's soil, and yes, there's going to be a primary regulator, but it's like big banks. We used to have this focus on what's the home country and what's the host country and so forth with banking institutions. We still do, of course, but at least through Basel, through the Basel Committee, we've come up with international standards that are more or less implemented. And somehow we have to get to that kind of a model and then have cooperation among regulators. I do not take the view that because a CCP is located in one country, that regulators from outside that country should have no visibility into that CCP. I think they have to have some visibility given the importance of these institutions. Whether that's through a college of regulators or some other mechanism, I'm not sure. But, we clearly don't want to get into a kind of nationalistic, no, this one's on our soil, stay completely away, and a breakdown of sort of where we were going with equivalence. But I think we, in some ways, need to go further to some sort of Basel type solution.
And
Great.
Interestingly,
Okay.
Bob,
Okay. Yeah.
last week we actually had the final text for recovery and resolution of CCPs finally passed trialogue last week. And I can tell you I started working on that when we finished EMIR in 2010. So it's been a long time coming, a whole decade before we finally have got, what was in essence the last piece of the jigsaw. These are too big to fail organizations. There are some global players in there, probably only 4 or 5, but they are systemically important, and they're systemically important to every large country around the world because they have their banks participating in all of them. They're all interconnected. And so if one actually has a weakness, I suspect there's at least 1 or 2 others that will actually be affected by it at the same time. And so it is a major systemic risk. but actually having a resolution authority required to be appointed and actually having, you know, the equivalent of a living will is surely a good thing. So, you know, in Europe, we didn't have that system up until, and it's still not on the statute book, so it's about to get there. And I do genuinely, you know, hope that now they won't wait for it to be implemented at some future date, that they just get on and do it. Every systemically important CCP should have a resolution authority so that you have the confidence to use it. And the regulators, those regulatory colleges, I guess looking back, it wouldn't take much to turn those regulatory colleges and those crisis management groups that are there for every systemically important CCP around the world. Why not make them into formal structures? Why not allow those regulators in those colleges to share the relevant important data so that they can, almost like the European Systemic Risk Board, make an assessment of where risk is building up and what they might need to do to intervene collectively in order to ensure the safety of the entire global system. I think we can have a much more cooperative system, but it's not about giving everybody equal access. It's about making sure everybody has the information and look through that they require for the stability and safety of their own markets and those of the interconnected space participants.
I certainly hear you when you talk about the long time you've been focusing on CCPs and recovery and resolution. I know that going back to when I was at ISDA, and I know continuing at ISDA, there's still discussions about the waterfall and how that all works, and getting the CCPs and the buy side and the sell side all together to try to come up with some solutions. I know it's a bit of a challenge. We've had a flood of questions in just the last 5 minutes or so, and several of them relate to LIBOR/IBORs. And one of them is from my successor at ISDA as CEO, Scott Amalia, has written to ask about that. And I would also mention, just mentioning ISDA, they published a very interesting survey last week of over 170 buy-side and sell-side institutions talking about how markets worked in the pandemic, what worked, what didn't, trade-offs between that higher level of capital that was required as a result of the last financial crisis, but also restrictions or unwillingness on banks' parts perhaps to lend in a time when lending was very much needed. So I would certainly recommend that particular survey to you. So Scott's asked about the transition, you know, what the effect of all this may mean for the transition. We also had a similar question from Pierre de Raval Descalpon, who's a Prime Finance member, asking, is everything going to take a back seat or on the LIBOR transition? And if people aren't focusing on that, are we facing potentially a financial crisis related to LIBOR transition when banks and the broader financial markets aren't ready to move to the new system? And also some concern about the replacement that's been identified over here in the United States, the so-called SOFR. Is that going to work? Is that going to have sufficient record and history and liquidity to be an effective replacement for US dollar LIBOR? So toss up on that one. Kay, Tim, who wants to tackle that one first?
Well, I mean, I'll just answer very briefly. You know, I think the transition away from at least what LIBOR has been over the years is still extremely important because, you know, we had seen over the course of many years, LIBOR move from something that had meaning, meaning it was based on real transactions many, many years ago, to something that had no transactions behind it and was simply quotes and was therefore very vulnerable to manipulation. So important to move off of it. The timing of that, you know, maybe gets affected by this. I'm not close to the ARC and the other work going on these days. But obviously, given all the other stresses on the financial system, we don't want to put unnecessary stress. But I think we still need to, I don't think it should change the objective. And, you know, I think SOFR can work. I think the complaints about it that I've seen are ones that can be dealt with in terms of, you know, interpolating rates and doing other things. So my view is still we need to move off it. But perhaps the specifics of that or the timeline of that might change given everything else that's going on.
Okay.
So certainly within the UK, the regulators are currently saying that yes, they've taken away interim timelines, but the end point remains the same. And so they are not shortening the time frame or lengthening the time frame by which the end use of LIBOR for new contracts exists. And they've been quite firm about it. Their argument is that there are very good reasons why you're shifting from using the IBORs in the first place, and therefore it should continue to happen. And they envisage that over the course of the next 18 months, there's enough time for that to actually happen in an orderly manner. I think there's a lot of pushback from the industry, and I'm sure Scott's amongst those campaigning and lobbying for not just the UK regulators, but also the European regulators to maybe take a slightly longer horizon on this, given that everything always seems to take longer to implement than one thinks. But the reality, without that deadline, I'm not sure many people will be motivated to move. So at least the forward-looking contract changing to the new system will start to give people confidence in utilizing the new alternatives. And I think once people start to transition, it's like everything else. Having confidence in the new mechanism will mean that people will then transition quicker rather than delaying. So I think that is the hope of the regulators. And I certainly, we're doing a lot of advisory work at the moment with the transition. I think it's easier for some firms than others. And the larger firms have been looking at this for quite some time and have a mechanism by which they're going to transition already worked out. The smaller firms are finding it incredibly difficult and are prioritizing other things. And now with the pandemic, it's easy to see why they'd be prioritizing other things. So, moving people off the LIBOR transition is something that you can justify at this point. But moving them back, when do you do that? When do you actually meet your deadline? Do you actually put the resources behind it that you require in order to be able to actually fulfill the policy ambition of shifting away from it? I have sympathy, but I also know that, when you've been going at it for so long and so many opportunities to try and do this over decades, finally they've actually bitten the bullet to do this. To pull back, I think would be a mistake. I think we just probably have to.
Yeah, and let me, if I may interject, I mean, I'm not by any means suggesting there should be any delay. I'm rather just speculating that I'm sure there are those people arguing for a delay, but I'm not close to those working on the timetable now. So, I share Kay's view that we've got to get there. If we can get there on the original timetable, that's great.
Yeah. So we had one specific question for Tim, one specific question for Kay. So Tim, you mentioned the money market reforms, and somebody was asking, what are those reforms? What would you advocate or see being done?
Yeah, well, one is to move to a truly floating NAV. And I think what we've seen is the notion of fees and gates that get implemented when there starts to be a little stress. That just drove people to pull out because they were worried that the fees and gates would come in. So that didn't work. But I think floating NAV is the main thing, and do that widely.
Is there what's the prospect of achieving that?
How
powerful the investor community is and groups down there in Washington.
It depends on that. It depends on the outcome of the election. It depends on a lot of things. And so I just think it's an area that we clearly need to focus on it because, the solution can't be that the Fed just intervenes every time.
Kay, for you, from Anthony Willis, who's one of our prime experts, he says, is it correct that the EU and UK do not agree equivalence? Then it makes it even harder and sets back further cooperation between regulators, certainly between UK and Europe, and even potentially globally.
I think the real sadness of that would be that you have the same rules the same rules with your regulators, and you have it being implemented, and you have the same law in your statute book. If at that point you cannot come to a technical equivalence decision that says you are the same and your output is the same because everything is identical, then what hope is there for future equivalence decisions? I mean, it kind of makes a bit of a mockery of things, given that both sides have worked with each other seamlessly as part of the union, and you know, moving outside of it shouldn't alter the technical competence of the FCA or the technical competence of the bank. So I get a little worried that this becomes nothing but an overtly political decision. And you know, just the fact that we were supposed to have had those equivalence decisions made by the end of June, and when the EU said that they weren't going to make those decisions known, the results of those technical assessments, until such time as an FTA had been politically agreed, that then politicizes it immediately. So it becomes tit for tat. And I think it's a really bad reflection when global financial markets, it's obvious that the interconnectedness has been demonstrated through the decades, you know, whether that's the last financial crisis or this pandemic, we see the interconnectedness of those markets. This is too big to play politics with. And I would suggest that, yes, it's right. If we can't agree this between the UK and the EU, then it makes a mockery of how you get this to work around the globe. And part of that was the Swiss agreement last week to try and actually demonstrate that you can do it a different way, that there is hope. And the UK would like to do that, I believe, with all the other global financial centres. So let's watch this space. I think some of the other global financial centres are quite interested in having a global standard emerge and to actually continue to do that work outside of the politics.
Yeah. Maybe we have time for one more question. Christopher Clark asks about the role that their virtual monopolies like SWIFT and Visa and MasterCard play, and how do you bring more competition into the payment system while maintaining the necessary consumer and small and medium enterprise protections?
Sure. Well, I mean, this is one of the reasons I've changed my view on Facebook's Libra and think, you know, we should come up with some a reasonable regulatory framework under which it can be launched. And I'm hopeful that will happen. The Swiss FINMA is the lead regulator, but they've made changes to the proposal, and I think, you know, they could bring more competition. I think we should look at other ways. Again, in the US, we don't have a federal framework for regulation of payment systems. And with all that's happening in the fintech space, you know, we can see a lot of new initiatives where people just potentially perform aspects of the payments role. And, you know, I think we want measures that we want a regulatory system that encourages that. And you can still build in the consumer protection and the SME protection. Mm-hmm. Central bank digital currencies are, you know, potentially another tool, but those really have a mix of advantages and disadvantages as I lay out in my paper. So I think the main thing is encourage, you know, we simply facilitate more private competition by having a regulatory system that allows new entrants.
Yep. Okay. Kay, anything to add to that?
So Europe has had the Payment Services Directive, and we've had PSD2 come out, which concentrated on making sure that new entrants, competitors, were able to enter the market. But I think, you know, things like Wirecard start to actually make regulators doubt themselves. So I think a more stringent regulatory framework will be a lot easier, so that everybody knows whose responsibility it is to make the checks, and which, you know, global centers need to cooperate in terms of exchange of information, so that you do make sure that when people say they're doing something, that it really is happening. Yeah. And I think, you know, it takes events like this to jolt certain activities. And I suspect that maybe what we'll see as a result of that is that the global payment system may have, you know, its time in the spotlight right now, and the whole, of the issues that Tim has just raised will actually become part of the policymakers' response to this crisis.
Well, that's great. Well, we've come to the end of our hour. And first, I want to thank Kay and Tim for your thoughts, your time. Really appreciated hearing from you on these various aspects of financial regulation, both what's worked, what didn't, and what we might see in the future. So thank you for your time. I also want to thank all of our attendees for their attendance. Thank you. I would mention that this event is one of a series of our primetime virtual events. Details of further events can be found on the Primetime Virtual Events page of the Prime Finance website. The link is being displayed in the chat box. The next session is Markets in a Pandemic, featuring Gay Evans, Blythe Masters, and Tom Jasper, and that's taking place next Tuesday, 10 o'clock Eastern Time, 14th of July. A link to register is showing in the chat box, and we'll also be sending it to you by way of follow-up. And as I mentioned before, we are scheduling, we don't have the exact date yet, but we will have very shortly a session where we will discuss the recently enacted UK Insolvency Act. That will be before the end of July. I'd like to thank Dwa Financial Technologies for their sponsorship of this first series of Primetime virtual events, and also LexisNexis and MLex for their support. If you're interested in sponsoring a future event, please do get in touch. We'd love to talk to you about that. And finally, Friends of Prime is a not-for-profit organization and accepts donations to support its work. If you'd like to make a donation or to find out more, please contact our secretary at Camilla McPherson using the details showing in the chat box. Kay, Tim, thank you again.
Thank you.
Thank you. It's been a pleasure.